The week starts with an energy boost for technology stocks particularly, as Sanae Takaichi in Japan scored a landslide victory during the weekend snap elections, meaning that Japan will continue to spend big, and it will spend big on defense and technology particularly. So markets are looking to extend Friday's rebound. The US dollar is under selling pressure again. Gold, silver, and Bitcoin are better bid, but the fundamental questions around AI and huge AI spending remain a dark spot aimed at optimism and could act like a speed bump for the bulls this week. So welcome to Swissquote's Daily Market Talk. It's Monday, February 9th. I'm İpek Özkardeşkaya, and everything I will say in this video is based on my own opinion and analysis, and this is not financial advice.
This show is brought to you by Swissquote.
So last week's hectic trading week ended with a rebound in technology stocks and Bitcoin. Optimism spilled through most assets that are trading on feelings these days, like gold and silver, for example. Nvidia jumped nearly 8% and pushed the Dow Jones Industrial Index above the 50,000 psychological mark for the very first time in history, with no major news on the wire other than Mr. Jensen Huang saying, I cite, to the extent that people continue to pay for AI and AI companies are able to generate a profit from that, they are going to keep on doubling. Duh. But what about the capacity constraints here? What about the speed of demand growth that may throttle behind investments, that may become obsolete faster than the depreciation rates that the big technology companies are using in their books today? And what about the circular deals, right? What happens if OpenAI, for example, misses a payment? Anyway, I'm not trying to dampen your optimism, but what I'm trying to say here is that the markets rebounded on Friday after a chaotic week, but the the fundamental and genuine questions that investors have in mind today and that keep investors up at night remain in place. Over the past weeks, remember, Amazon, Google, Meta, and Microsoft together announced plans to spend around 650 to 700 billion US dollars on AI-related investments, and that's only for 2026. That is huge, and more importantly, way higher than the early estimates from market. Now, obviously, a big chunk of that will go into the enablers pockets like Nvidia, AMD, memory chip makers, data centers, and so. But at some point, the spending spree or this race to spending also looks like a show off from these big companies to show the others that they are in the race and they are being serious about being the winner. The question is, are they getting ahead of themselves and getting away from the reality of the field? We won't have the answer today, but remember, big gains like the ones that we saw last Friday are as unsettling as big losses, as they both mean. Both big gains and big losses mean that the markets are navigating through agitated waters and gains may not be sustainable. Now, the good news is that the Japanese PM Sanae Takaichi won, and she won big her bet in the weekend snap elections in Japan. She actually pulled off a stunning victory with her ruling LDP scoring a historic landslide. She secured a 2/3 supermajority in the powerful lower house of parliament, and even more if you count in this new coalition partner. That not only gives her party the most dominant position in the lower house in decades, but also a very strong mandate to push through her agenda on economic stimulus that will particularly benefit the defense and technology areas. This is probably why we see the Korean Kospi Index rebound nearly 4% in today's trading session. But again, there's a chance that the technology rebound that we see today has a few speed bumps on the way. We will see what happens. But elsewhere across the Japanese markets, the JGB yields jump open the week, obviously, with no surprise, with the 10-year JGB yield returning to the highest levels in a week on fiscal spending worries. The Nikkei and Topix indices jump open the week as well, both hitting fresh record highs on ample fiscal spending outlook and growth optimism that comes with it. But the Nikkei gave back most of the earlier gains, probably on the rising pressure on the Japanese yield, suggesting that growth will come at a cost. But the Topix index is holding on to its gains at the time I'm talking here, with a more than 2% rise this morning just before the European opening bell. In the FX, the Japanese yen get lower at the open, but quickly retraced earlier losses, suggesting that the currency trader is still in favor of the idea that the Bank of Japan won't hesitate much to act if inflation in Japan starts to run too hot with such an expansive fiscal plan. But the yen's rebound today still looks like a period of daydreaming, a period of honeymoon before the reality of fiscal spending sinks in for a country whose fiscal ambitions may be running well ahead of its wallet. In summary, the Japanese yen may not be reversing its losses for good. Now, moving away from Japan, the US dollar index kicks off the week with a renewed selling pressure. That's obviously partly due to the gains that we see in the Japanese yen this morning, but gold and silver are better a bit this morning as well. The dollar franc continues to push lower. On the other hand, the pair formed a solid resistance at the beginning of this month of February and is one of the rare assets that are left in the safe haven space. I mean, let me know if you have any other options in the comments below. Bitcoin, on the other hand, consolidates near the $70,000 mark this morning, having successfully built a support near the $60,000 psychological level in last week's slump. It is, however, quite hard to call if the worst here is behind us. Technically speaking, the rebound that we saw since last Friday hasn't even pushed the coin to a minor Fibonacci retracement level, which is the 23.6% retracement on the October to last week's sell-off. That stands near the $77,000 per coin. So for now, Bitcoin still remains in the bearish consolidation zone with the risk that come along with it. Now, I believe that with the big technology earnings and the spending announcements behind us for a while, this week could see the markets digest the news, especially the spending news, reprice, readjust expectations, and consolidate. This is of course subject to surprise news that could come anytime and from any direction. But on the earnings front, we have Coca-Cola, McDonald's, and Cisco. They are among the biggest names that will go to the earnings confessional this week, and they're not necessarily your major market-moving companies. On the geopolitical front, US crude returns to the 200-day moving average this morning as the weekend talks between the US and Iran were very good, according to the US president. But were they good enough to justify the end of these tensions to keep oil in the bearish trend, meaning below the $64 per barrel level, which matches the major 38.2% Fibonacci retracement on summer 2025 slide? Well, that's to be seen. The risks remain two-sided in this market with the long-term outlook on the bearish side. On the data front, the week's agenda is full of key US metrics, including official jobs data due to land on Wednesday and inflation due on Friday. The expectations here point at ongoing weakness in the US jobs figures with weakening inflation, which is the best possible combo for the Federal Reserve does, mind you. And in the absence of major economic data from other major economies, the US dollar will likely remain in the driver's seat in the FX bust this week. The major currencies kick off the week with solid gains. The euro dollar and cable are up at the time I'm talking here, but with uncertain backing still from the European Central Bank and Bank of England outlook perspective. That's especially true in the UK, where the bets that the Bank of England is this close to a rate cut should limit the gains. The Aussie dollar, on the other hand, is back above the 70 cents level this morning and deserves to extend its gains to 0.72 mark on the back of this divergence between RBA and Federal Reserve outlooks, a move that would officially mark the end of the 2021 to 2025 retreat. The Aussie yen, on the other hand, one of the favorite carry trades of all times, hit a fresh record high this morning as despite the rapidly rising JGB yields, the rate differential between Japan and Australia remains amply satisfying for carry traders to keep going. The biggest risk here is a direct FX intervention from the Japanese authorities, who are quite unhappy and very much concerned about the yen's rapid depreciation and its extremely negative ripple effects for Mr. and Mrs. Everybody in Japan. So this is all for this Monday. I'm İpek Özkardeşkaya, and thank you for joining me, and thank you for all your beautiful and supportive comments. I hope this episode of Market Talk has been helpful and it has been insightful to you. So please do not hesitate to leave your comments, your reactions, and your questions below, as usual. Follow us on Instagram, on X, on LinkedIn, but also on WhatsApp, Threads, Telegram, and Blue Sky for regular market updates. Subscribe to our YouTube channel for daily market comments. And please don't forget to hit the like button on these videos to let us know that you enjoy them. So I will meet you again tomorrow. And until then, good day trading.
Trading and investing carry risks, including capital loss. CFDs in digital assets are volatile and not suitable for everyone. Swissquote assumes no responsibility for accuracy or losses from its use. Products and services are offered only where legally permitted.